Right friends, welcome back to Learning Space. This is the first capsule for 18th week, and here there are several articles with regard to rupee appreciation in recent times, and I clubbed all the details pertaining to rupee appreciation. Here I already covered in the capsule of 13th week what are the reasons for rupee rise or rupee appreciation. Please go through that, and in the present discussion I am going to cover what is the macroeconomic situation of the country at present, and the second point is because of rupee appreciation, who are the winners, who are the losers, that aspect we are going to deliberate. And the first part, what are the reasons for the rise of rupee. I listed 5 points in this lecture, capsule 1 of 13th week. I am not going to discuss now, but for the sake of the students, whoever not viewed that capsule, I kept PPT part here. So first of all, appreciation, depreciation due to market forces, revaluation, devaluation when government deliberately does it. Then 5 reasons which I have listed, I included in the PPTs, go through them. First reason, second reason, third reason, fourth reason, fifth reason. These 5 were the reasons for the recent rupee appreciation. Right. Let us come back to the present discussion. Here, going forward, what is going to be the likely scenario? Foreign portfolio investment in debt equities. Whatever the reason, there are reasons for it, but overall, there is a sudden increase in the foreign portfolio investments in recent times. Foreign portfolio investments increased suddenly during the past 2 months, and in fact, FPIs already invested $7.5 billion in debt during the past 2 months predominantly, and here this is higher than $7.4 billion for the entire calendar year of 2015. Right? So, it is a huge capital inflows into the country. Then similarly, in the equity segment also, during the past 4 months, $6.38 billion, and in fact, it is double the money which flowed into the country during 2015 as well as 2016. So, the proposed hikes by the Federal Reserve of United States of America may not influence financial markets in our country, and FPI flows in debt most likely to continue, right? Then if you look at the next scenario, dollar index. Dollar index is the index which is based on various prominent currencies with the dollar. The currencies like euro, pound, and the index is based on the performance of dollar with its major currencies. So, dollar index, here it came down below 100, and during the past 3 months, it came down from 101.5 to current level of 98.5, and it is coming under pressure. And the important currencies while calculating the dollar index are euro as well as pound. In recent times, euro and pound got strengthened. Here, recent developments in Europe are also adding pressure on the dollar, as euro and pound is being strengthened in recent times, and it indicates that dollar index may continue to be weak. Look at exports or current account deficit. Here, exports increased substantially during February, March, but one important point, the low base, don't forget, and this may be probably due to low base or base effect. And here, imports also increased so that the trade deficit could not be controlled. Exports increased, positive sign, but imports also increased partially due to the increase in oil prices probably, right? So, because of increase in imports, trade deficit could not be controlled. And another point is, current account deficit is also widening. Please look into this. It reached here, and subsequently it is going down. That means the deficit is widening. So in future, two factors will determine current account deficit. The two factors are how the oil prices are going to be, that is one factor. The second factor is gold imports, right? It all depends on these two. And don't forget, our exports stood at $275 billion last year and imports $380 billion, and there was a mercantile trade gap of $105 billion. Please don't forget. And if you look at debt, debt is not the worrying factor. Long term debt has come down sharply to $372 billion, and for any country, please don't forget, long term debt is not a major problem, but short term debt is the problem. But short term debt is not substantial for our country, and it is around $83 billion. Short term debt is more dangerous, just like unhedged foreign currency loans by the corporates. So certain things in economy, please don't forget. So there is no problem as foreign exchange reserves are sufficient to tackle the situation. That is the one important aspect. The second important aspect is the substantially lesser short term debt, right? So these two are positive factors. If you look at foreign exchange reserves are now $369 billion. You see, they are around $369 billion, and any country requires foreign exchange reserves to take care of 10 months of imports. That is known as import cover. Import cover means the foreign exchange reserves required to take care of 10 months of imports, and our annual imports last year $380 billion, and our foreign exchange reserves are $369 billion. So we are quite comfortable, and import cover is around 12 months. But the point is, geopolitical tensions are rising between US and North Korea. So these reserves are sufficient to tackle any unexpected volatility, especially because of crude oil front. Then if RBI intervenes by selling the rupee and buying the dollar, it can further bolster the reserves, and this is known as managed float. If rupee further appreciates, then RBI may intervene and purchase dollars by selling rupee. But what happens? Rupee liquidity will further increase. That is going to be another problem. So these things, please don't forget. So foreign exchange reserves are sufficient to take care of any volatility, and they are sufficient for 12 months of import cover, right? Then if you look at real effective exchange rate is calculated with 6 currencies of trading countries with India and 36 currencies. One index is 6 currencies, other index is 36 currencies, and if you look at any of these indices, it is greater than 100. Please don't forget, real effective exchange rate. What is the meaning, you may ask? Real effective exchange rate is the weighted average of a country's currency relative to an index or basket of other major currencies adjusted for the effects of inflation. So it is the weighted average of a country's currency relative to an index or basket of other major currencies. So here real effective exchange rate is more than 100. That means the currency is overvalued. Please don't forget, when the real effective exchange rate is less than 100, it indicates that the currency is undervalued. So at present, the currency is overvalued, and as I have already told you, if the currency further strengthens, it may affect the competitiveness of our exports, and RBI may be required to intervene, which is known as managed float. Right? This is about REER or REER. So we deliberated on various macroeconomic concepts, and we already deliberated rupee raise, the reasons for rupee appreciation in 13th week. And in this lecture, we deliberated about the debt, at the same time real effective exchange rate, foreign exchange reserves and FDI flows. All these aspects we deliberated. The final word is what is going to be the future scenario with regard to rupee appreciation or depreciation. There are 5-6 factors which determine rupee appreciation or depreciation. First one is FDI inflows. At present there is no problem. Strong FDI inflows are there, and sometimes it gives the impression that stock market, there is some bubble in the stock market because of excessive foreign portfolio investment flows into the country. Then weakness of the dollar, whether the dollar index, which is at present lesser than 100, whether it will continue or not, that is second point. Widening of the deficit, current account deficit widening, all depends on the increase in oil prices and gold imports. Then I have already told you outlook for gold and oil prices. Overvalue of the rupee based on real effective exchange rate, this is one important factor, and whether real effective exchange rate, whether it is going to be above 100 or whether it will further go beyond 106 or 115, whatever it is. So all depends, and based on that our export competitiveness will be decided. Then geopolitical tensions because of North Korea, United States of America issue, then upcoming elections in United Kingdom and France. So all these factors will determine the future scenario of rupee appreciation or depreciation. Finally, who are the beneficiaries? Who are the losers because of rupee appreciation? Beneficiaries are country will be benefited as a whole because of less costs on oil imports. When rupee appreciated, what happens? Less costs on oil imports. So because of that, inflation will be under control because we are dependent on foreign countries for 70 to 80% of our imports. Then corporates will be benefited because of less cost on importing capital goods. Our most of the capital goods, I told you several times the difference between capital goods and consumer goods. Capital goods are the heavy machinery which is required to manufacture consumer goods like this pen, maybe like this shirt. So capital goods are heavy machinery, and capital goods may become cheaper because of rupee appreciation. Then foreign portfolio investors will be benefited because of rupee appreciation, because these are short term investments, and short term investors will definitely benefit much when rupee appreciates. Then foreign tours will become cheaper because of appreciation of rupee for the citizens of the country. The companies which have outstanding debt in foreign currency may be benefited, and you may have a pertinent doubt, who are the losers? The losers are exporters. Then exports may become globally uncompetitive because of appreciation of rupee. If rupee further appreciates, probably the exports may become further uncompetitive. Then Indian multinational companies which have their operations abroad, when rupee appreciates, they will be the losers. Then Indians who are dependent on foreign remittances. If son is working in America, if he sends $100, now with 64 rupees, now parents will get just 6400 only. If the rupee versus dollar is rupee 70, the parents will get 7000. So there is lot of difference. So these Indians who are dependent on foreign remittances, they will be affected, and IT, BPO sector will be affected, right? So we discussed macroeconomic fundamentals as far as future path for rupee is concerned. And second thing is, we also deliberated on the beneficiaries and losers. Right friends, this lecture concludes here. Have a nice day. Thank you.